Outdoing the competition, everyone tries to do it, but only a few are successful. And in this video, I'll tell you 5 reasons why you're not doing better than the market. But before that, if you're new to this channel, hit the subscribe button and the notification bell so you don't miss any of our videos. So, without further ado, let's get started. Reason number 1. Your fees are too high. Fees for investments are one of the main things that make it hard to beat the market. If you listen to common advice and buy an S&P 500 fund instead of individual stocks, your fund should do as well as the S&P 500 for better or for worse. But investment fees will be taken out of these returns, so you don't even come close to matching them, let alone surpassing them. This is why you should look for index funds with very low fees, between 0.5% and 0.2% per year. If you can't beat the market, you'll at least be able to keep up with it. Taxes are another major problem that makes it hard to beat the market. When you pay taxes on gains from investments, you lose a big chunk of your money. Unless you have a very low income, the tax rate on capital gains is between 15% and 20%. This is a tax on investments that have been held for at least a year. Shares that are only held for a short time are taxed like other income. Cost ratios are used to look at expenses for companies and mutual funds. A company with an annual spending budget of $1 million and a total value of $10 million has a spending rate of 10%. An ETF with a cost index of 1% spends 1% of its total assets each year to cover its costs. Every spending ratio of 15% or more is considered high and can have a big effect on the return on investment. Reason number 2. You aren't doing enough research. If you want to build a portfolio that gives you higher returns than the market as a whole, make sure you have the time and are willing to do the research. Due diligence is a study that investors should do before they put money into something. Before you put your money into a new investment, you should look at the last 4 earnings reports. Companies that are listed on the stock exchange report their financial results every 3 months. By reading the last 4 reports and comparing them one by one, you'll get a good idea of how stable the company's finances are. If a company does many things that cost investors money by stealing the value of their shares, those things will be listed in the SEC filings. It's never a good idea to blindly follow the advice of investment analysts, money managers, professional investors, or other experts. This is to make sure that your idea of a bubbly company is correct before you add a new investment to your stock portfolio. You can also look into how the market has been doing. Even when everything seems to be going right, market results don't always match what people think is true. No matter how strong a company is, investing in a trend that is going down is rarely a good idea. Reason number 3. You let your emotions impact your returns. On the stock market, the bulls and bears are always at odds. This fight is fueled by fear and greed, which makes it hard to stay calm. Instead of letting your feelings influence your investment decisions, stick to the plan you made. Remember that sometimes you'll have to take a loss, but your plan for investing makes it more likely that you will make money. Now, the best way to make money on the stock market is to stick to the plan. People tell you all the time about investments that are a sure thing. There is only one way to go: up. So you put your money in and get ready to ride to the top. The only problem is that things rarely go as planned, so the investor goes bankrupt quickly. Many different things can happen out of the blue that can destroy the value of a single resource. Even the biggest companies in the world can't keep this from happening. You can also make a big mistake by putting too much money into one investment because you care about it. If something goes wrong, you'll have to put all your eggs in the basket that broke. You are trying to time the market, which is the 4th reason. Reason number 4. You are trying to time the market. For your investment to give you better returns than the market as a whole, you need to get in and out of it at almost exactly the right time. But it's not easy to know when the market will go up or down. Even with the best technical indicators, the most expensive education, easy-to-use trading tools, and a deep understanding of how the stock market works, traders often make mistakes that cost them a lot of money when they try to predict how the stock market will move over time. Some famous investors like Warren Buffett, Peter Lynch, and Carl Icahn seem to have a knack for knowing when to get in and out of the market, but even they have made mistakes that have cost them a lot of money. The risk of market synchronization is too high for the average investor, who has a much smaller portfolio than these business tycoons. Most small investors don't understand how the stock market works, which is a shame. Most of them have full-time jobs, so they don't have the time or money to get this kind of education. In theory, the market is made by people who know what will happen when they make a choice, but this isn't the case at all. Keep watching. In this video, I'll explain what I mean. Most people who invest their money tend to follow the advice of so-called experts instead of looking into the details themselves. When some of these ideas turn out to be true, the problem gets harder to solve. By chance alone, it makes people think that they can make money by following such unreliable and misleading stock trading rules. One of the problems when investing in the market is that there is a high chance that you will fail. Timing the market is a risky and unsustainable strategy, and you don't have to go further than the odds to prove it. Consider that market timing involves making two choices. When to get into the market is one choice, and when to get out of the market is another. If you don't look at the important details and just look at the odds, there's a 50-50 chance that one decision will be right. So, there is a 25% chance that both decisions will be the right ones. So, it's likely that only one in every 4 bets will pay off, while the other 3 will lose. People who think they can time the market don't know what the odds are very much against them. There is less than a 10% chance of making money. Also, even if you win, you're likely to lose everything on your next bet. Studies have shown over and over again that small investors who think they can time the market almost always lose money. Another point is that it's almost impossible to stick to this plan. The idea that markets always move in sync is kept up. Some small investors make money during booms, but they don't realize that a rising tide lifts all boats and that their bets will do well because the market is just going up. So, if you want to be successful with your investments, you should think long term. You might make a few bucks quickly if you jump in and out of the market, but this is dangerous. And you already know that if you play with fire, you'll get burned. Reason number 5. You are too invested in low-risk assets. Diversification is an important part of any portfolio of investments. It is the process of putting money into more than one investment to spread out risk and protect your money from the ups and downs of the stock market. Most strategies for diversification include low-risk asset classes like bonds and other fixed income securities. But asset classes with low risk tend to have the lowest possible returns. If you want to make more money in the market as a whole, you need to keep your allocation to low-risk asset classes as low as possible. But it's also important to remember that putting more money into asset classes with less risk will make you more likely to lose money. You have to take more risks to beat the market. But even though taking more risks can lead to more money, don't forget it can also lead to big losses. Yes, it has two sides to it. You will need to have faith in the market, and a lot of that depends on what investors say about their thoughts. Negative thoughts are so contagious that they can cause a mass panic that leads to big sales, lower prices, and even a market crash. Some high-risk investment strategies that can help you beat the market are actively managed mutual funds, hedge funds, and day trading. But these methods usually only work for investors who have a lot of money or who have been trained and equipped by professionals. But for most investors, pose risks that can be avoided. In short, to beat the market, you have to get past several nearly impossible obstacles. And that's it for this video. Before you go, don't forget to like, comment, subscribe, and click the notification bell for more videos like this. Thanks for watching and see you next time.